External audits operate within a comprehensive regulatory framework designed to protect the public interest by enhancing the credibility and reliability of financial reporting. In most jurisdictions, legislation requires public interest entities and large companies to prepare annual financial statements and have them independently audited by qualified auditors. The audit profession is further regulated by national legislation, professional accountancy bodies, securities regulators, and international standard-setting organizations. This framework establishes minimum standards for auditor competence, ethical behavior, quality management, independence, and reporting responsibilities, thereby promoting investor confidence and efficient capital markets. The regulatory environment ensures that audit opinions can be relied upon by shareholders, creditors, regulators, and other users making economic decisions. The regulation of auditors is necessary because of the significant public reliance placed upon audited financial statements. Investors and stakeholders generally lack direct access to internal corporate information and therefore depend upon auditors to provide independent assurance regarding management's financial representations. Without regulation, inconsistent audit quality, conflicts of interest, or professional misconduct could undermine market confidence and economic stability. Regulatory oversight aims to maintain audit quality through licensing requirements, continuing professional education, ethical codes, quality inspections, disciplinary procedures, and enforcement mechanisms. These safeguards reduce agency conflicts between shareholders and management while reinforcing auditor independence and professional competence. Professional regulation is implemented through a combination of statutory legislation and professional self-regulation. Governments establish legal requirements concerning audit eligibility, registration, and public oversight, while professional bodies establish ethical principles, technical guidance, and disciplinary processes. Audit firms are subject to periodic quality inspections to ensure compliance with professional standards and quality management systems. In addition, mandatory continuing professional development ensures that auditors maintain technical competence as accounting standards, technology, and business practices evolve. Together, these mechanisms enhance audit consistency, reduce audit failure risk, and strengthen public trust in financial reporting. Statutory regulations govern the appointment, removal, resignation, and replacement of external auditors to preserve their independence from management influence. Typically, shareholders appoint auditors at the annual general meeting because auditors report directly to shareholders rather than company directors. The initial appointment may be made by directors before shareholder ratification, but subsequent appointments generally remain the responsibility of the owners. Auditors cannot be removed arbitrarily by management. Formal procedures requiring shareholder approval and notification are normally prescribed by company law. Similarly, where auditors resign before completing their term of office, they are generally required to submit formal statements explaining the circumstances of their resignation to shareholders or regulators, ensuring transparency and preventing management from concealing disagreements over financial reporting matters. External auditors possess important statutory rights that enable them to perform their work effectively and independently. These rights typically include unrestricted access to accounting records, supporting documentation, explanations from management, and information necessary to complete the audit. Auditors also have the right to attend general meetings, receive notice of shareholder meetings, and communicate directly with shareholders regarding matters affecting the audit. These legal rights ensure that auditors can obtain sufficient appropriate evidence and discharge their professional responsibilities without undue interference from management or those charged with governance. Alongside these rights, auditors have extensive professional duties and responsibilities. Their primary responsibility is to obtain sufficient appropriate audit evidence and express an independent opinion on whether the financial statements present a true and fair view in accordance with the applicable financial reporting framework. Auditors must comply with international standards on auditing, ISAs, maintain professional skepticism, exercise professional judgment, preserve independence, and adhere to ethical requirements including integrity, objectivity, confidentiality, professional competence, and professional behavior. They are also required to report certain legal or regulatory breaches where legislation permits or requires disclosure in the public interest. Despite their importance, external audits possess inherent limitations that prevent the provision of absolute assurance. Financial statements frequently contain subjective estimates, complex judgments, and assumptions that cannot be verified with complete certainty. Auditors rely extensively on sampling techniques rather than testing every transaction, while audit evidence is generally persuasive rather than conclusive. Furthermore, sophisticated fraud involving collusion, management override of controls, or falsified documentation may remain undetected despite properly conducted audit procedures. Consequently, the auditor provides reasonable assurance that the financial statements are free from material misstatement rather than guaranteeing absolute accuracy or detecting every instance of fraud and error. International Standards on Auditing, ISAs, issued by the International Auditing and Assurance Standards Board, IASB, establish globally recognized principles and procedures governing the conduct of external audits. ISAs promote consistency, comparability, and audit quality across jurisdictions by providing guidance on planning, risk assessment, evidence gathering, documentation, reporting, and quality management. Although ISAs themselves do not possess legal authority, many jurisdictions adopt them directly or incorporate them into national auditing regulations. National standard setters may supplement or modify ISAs to reflect local legal requirements, but where differences arise, local legislation normally prevails.